What if I told you that you could make $50 million a year and pay absolutely zero in taxes? It's not a dream, it's a strategy that the wealthy use, and it all comes down to one powerful investment: multifamily real estate. In this video, I'll explain how this strategy works and how you can use it to build wealth and keep more of your money. If I could go back 30 years, no, even just 15 years ago, and put my money into a place where it would make the most money while allowing me to keep it all, there's no question. I would have invested in multifamily real estate. The reason for that is simple. Multifamily properties don't just generate passive income, they offer tax benefits that are essentially unparalleled in any other asset class. Here's what makes multifamily real estate such an incredible wealth-building tool. Not only does it allow you to make a steady income, but it also provides the opportunity to write off a large portion, if not all, of your income. So, if you own enough real estate, you could be making tens of millions of dollars a year and still pay zero taxes. The secret lies in the way real estate works to protect and grow wealth. Cash flow. Multifamily properties, such as apartment buildings, duplexes, or triplexes, are among the best assets for generating consistent cash flow. What makes them so powerful is that once the property is established and the tenants are in place, you earn money regularly without much active involvement. Unlike other investments such as stocks or businesses, the rent paid by tenants is usually stable and predictable. Whether the market is going up or down, as long as you have tenants, you're receiving a steady income stream. This is one of the greatest advantages of real estate. It doesn't rely on market volatility or your direct efforts once the property is up and running. Tenants pay rent. Every month your tenants pay rent, and that money flows into your account, allowing you to cover operating expenses and mortgage payments while still earning income. The more units you have, the greater the potential for diversified cash flow. Even if one tenant moves out or falls behind on payments, the others can help ensure a consistent income stream. Less dependence on external factors. The key to cash flow from real estate is that it's not tied to the stock market, interest rates, or other external financial fluctuations, at least not directly. While other investments can fluctuate greatly, the rental income from your multifamily property is generally more stable, as people will always need a place to live. Scalability. Multifamily real estate properties scale in a way that other forms of income can't. For example, a 10-unit property can provide cash flow 10 times over, and as your portfolio grows, so does the income you generate. This allows you to gradually increase your passive income without much additional time commitment once the properties are purchased. Tax benefits. One of the most attractive features of multifamily real estate is its incredible tax benefits. Real estate provides several tax advantages that other asset classes, like stocks or bonds, simply can't offer. The primary tax benefit that real estate investors leverage is depreciation. Depreciation is a tax deduction that allows you to deduct the value of the property over time, often 27.5 years for residential properties, from your taxable income. This means that even if the property is appreciating in value, you can still write off a portion of its value each year, reducing the amount of income you have to pay taxes on. For example, if you make $50 million a year but have a significant real estate portfolio, depreciation allows you to write off a substantial portion of your income, effectively reducing your tax bill. Example: let's say you own a multifamily building worth $10 million. Each year you can depreciate a portion of that value, even though it's increasing in market value. This reduces your taxable income significantly, potentially bringing your overall taxable income down to a fraction of what you would have paid without the depreciation deduction. In some cases, this could reduce your tax liability to zero, even with substantial earnings from other sources. Tax deductions for operating expenses. In addition to depreciation, you can deduct many of the operating expenses related to the property. This includes property management fees, maintenance costs, insurance, and property taxes. All of these deductions lower the amount of taxable income you report at the end of the year. 1031 exchange. Another key tax strategy available to real estate investors is the 1031 exchange, which allows you to defer paying capital gains taxes on the sale of an investment property if you use the proceeds to buy another similar property. This is a powerful tool that allows you to grow your real estate portfolio without taking a hit from taxes. Leveraging debt to build wealth. One of the most powerful aspects of multifamily real estate investing is the ability to leverage borrowed money to grow your wealth, often with minimal tax consequences. When you purchase real estate, you can typically borrow a large portion of the property's price, usually 70 to 80% through traditional financing. The key benefit here is that the money you borrow is not considered taxable income. Only the income generated by the property, rents, etc., is subject to taxation. Using leverage. This allows you to amplify your investment without having to come up with the full amount in cash. For example, if you buy a $1 million multifamily property and borrow $800,000, you're only putting up $200,000 of your own money. The tenant rents pay off the mortgage, and the property's equity increases over time as the loan is paid down. Borrowing against equity. As the property appreciates in value and the tenants pay down the mortgage, you accumulate equity in the property. This equity can be used as collateral to borrow more money through a cash-out refinance or a home equity loan to acquire more properties. Example: if your $1 million property appreciates to $1.2 million over 5 years, you've gained $200,000 in equity. You can then borrow against this increased equity without paying taxes on the borrowed amount and use the money to purchase another property, further expanding your real estate portfolio. The income generated by the tenants in the new property will help pay off the debt, increasing your wealth with minimal risk. Appreciation and value growth. While the primary benefit of owning multifamily real estate is cash flow, appreciation, or the increase in the property's value over time, is another powerful wealth-building factor. Income-based valuation. The value of a multifamily property is directly tied to its ability to generate income. Unlike residential real estate, whose value is based primarily on comparable sales in the area, multifamily properties are often valued based on how much income they generate. The more rent you can charge and the more units you have rented out, the higher the property's value becomes. Example: if you own a multifamily building with 20 units and increase the average rent by just $50 per unit per month, that could add thousands of dollars to your property's value. This increase in rent directly impacts the property's overall valuation, which increases your net worth. Increasing rent and reducing vacancies. Multifamily properties offer a unique opportunity to improve profitability and increase their value through simple operational improvements. By reducing vacancies and increasing rent, in line with market rates, you can significantly increase your cash flow and therefore the value of the property. Value-add strategies. In many cases, you can implement value-add strategies, such as renovating units, adding amenities, or improving management practices to further increase the property's value. These improvements lead to higher rent and can significantly increase your returns on investment. Now you might be wondering, how do you actually get started in multifamily real estate? And what's the best strategy to begin building your portfolio? Stay tuned, because I'm about to share exactly how you can begin creating wealth with real estate, whether you're starting with a small investment or going big from the start. Let's talk about how to start investing in multifamily real estate and begin leveraging all the benefits we just discussed. Start small or go big. When it comes to multifamily properties, there are options for both beginners and seasoned investors. You could start with a duplex or triplex if you're new to real estate, or go bigger with an apartment complex if you have more capital. For beginners, starting with a small multifamily property is a great way to get your feet wet while learning the ropes. You'll gain experience with tenants, property management, and financing, all of which will give you the tools to scale your investments later on. For more experienced investors, scaling up quickly with larger properties like 50-plus unit buildings can give you greater returns, economies of scale, and tax benefits. With more units, the property's ability to generate cash flow increases significantly, making it easier to leverage debt for future investments. Financing multifamily real estate. One of the most powerful things about real estate is the ability to leverage other people's money, or OPM. Instead of needing to have millions of dollars in cash to buy a multifamily building, you can secure financing through banks, private lenders, or government-backed loans like FHA or VA loans. In fact, real estate investors often use the bank's money to purchase the property and then pay off the loan using the rental income generated by the tenants. This is the foundation of using leverage to grow your wealth. Example: you might find a multifamily building worth $1 million, and you can finance 80% of the purchase price, meaning you only need to put down $200,000. In return, you'll start generating rental income from the tenants, which can pay off the mortgage and even provide a surplus for you. Property management and maximizing profit. The key to success in multifamily real estate is effective property management. Whether you choose to manage the properties yourself or hire a property management company, you need to focus on maintaining the property and ensuring that it stays fully occupied. High occupancy rates ensure a steady flow of income, which is critical for leveraging the power of your property. If you're looking for higher returns, consider adding value to the property through upgrades, better tenant screening, or other improvements that make the property more appealing to renters. Tax strategies for real estate investors. Once you have a few properties in your portfolio, it's essential to work with a tax professional who understands real estate. There are several ways you can take advantage of tax breaks. As mentioned earlier, the IRS allows you to depreciate your real estate over time, which can offset rental income and reduce your overall tax liability. A 1031 exchange allows you to defer taxes on capital gains by reinvesting the proceeds from the sale of one property into another, essentially allowing you to defer paying taxes on profits. So now that you know the power of multifamily real estate, what's the next step? How do you find the right properties, get financing, and start scaling your portfolio? Well, in just a moment, I'll show you the best strategies for finding profitable multifamily deals and leveraging your investments to build lasting wealth. Research and market selection. The first step in finding a great multifamily property is selecting the right market. The market you choose has a significant impact on the future profitability of your investment. You want to find areas that not only have good current rental demand, but also show long-term potential for growth. Here are some critical factors to consider. Population growth. Choose markets with growing populations. More people moving to an area means more demand for housing. Markets with job growth, especially in key sectors, will often see a rise in population as people move in for work opportunities. A growing population generally leads to a steady demand for rental properties. Example: areas like Austin, Texas, or Raleigh, North Carolina, which have seen a surge in tech workers moving in, are prime examples of markets with growing populations. These cities attract young professionals, which leads to high rental demand and low vacancy rates. Economic indicators and job growth. Cities with strong local economies, like those with low unemployment rates, are likely to support stable or increasing rental demand. Pay attention to economic drivers such as corporate relocations, infrastructure projects, and the rise of specific industries, for example, tech, healthcare, manufacturing. Example: cities with a growing tech scene like San Francisco or Seattle, or those near major universities, for example, Boston, Massachusetts, or Berkeley, California, often experience constant tenant demand. People are drawn to these areas for educational and career opportunities, making them attractive spots for multifamily investments. Proximity to key amenities. Areas close to good schools, healthcare facilities, and public transportation are often key indicators of future growth and tenant retention. Families, students, and professionals alike look for areas where these amenities are readily available. Example: if a city is building new public transit lines or expanding its transportation infrastructure, this can dramatically increase demand for rental properties. Areas near universities or medical centers also tend to have a steady flow of tenants. Vacancy rates and rental prices. Low vacancy rates and high rental prices are clear signs that a market is strong and competitive. Look for areas where rental demand is consistently outpacing supply. Vacancy rates under 5% are typically a good indicator of a strong market for real estate investment. Example: research online platforms such as Zillow or Rent Cafe for insights on vacancy rates and average rental prices in different areas. Finding deals. Once you've identified a strong market, the next step is finding the right deal. While the market might be promising, the key is locating properties that offer the best return on investment, or ROI. There are several ways to find good deals. Real estate agents and brokers. Building a relationship with an experienced real estate agent or broker who specializes in multifamily properties can be invaluable. They have access to the Multiple Listing Service, or MLS, and often know about off-market deals that aren't publicly advertised. Here's a tip. Ask your agent to help you identify underpriced properties or buildings that are being sold by owners who are eager to sell. Networking with other investors. Networking is one of the best ways to find investment opportunities. Attend real estate investment groups or meetups, both locally and online, to connect with other investors who may be looking to sell properties or partner on deals. The relationships you build can lead to exclusive opportunities that aren't widely available. Example: attend events or groups like BiggerPockets, a popular online platform for real estate investors, to exchange ideas and access off-market properties. Online platforms. Several online platforms specialize in multifamily real estate listings, making it easier to search for properties that meet your criteria. These platforms allow you to filter properties based on price, location, size, and other factors. Some even let you view financial performance data, which is crucial for assessing potential profitability. Example: platforms like LoopNet, Realty Mogul, and CrowdStreet are excellent resources for browsing available multifamily properties. You can narrow your search by region, investment potential, and cash flow, helping you find the best deal within your budget. Local property auctions. Properties can often be purchased at auctions at a significant discount. Keep an eye on local foreclosure auctions or bank-owned properties. Sometimes these properties are priced much lower than market value, and with the right knowledge, they can present a great opportunity for investors. Here's a tip. Be sure to research the property thoroughly before bidding, as auctioned properties may come with unforeseen repairs or legal issues. In conclusion, multifamily real estate is one of the most powerful ways to build wealth, generate income, and reduce your tax burden. By investing in real estate, you can leverage debt, generate passive income, and benefit from huge tax breaks, all while growing your wealth over time. Whether you're starting small with a duplex or jumping into large apartment buildings, the key is to begin today and continue learning and growing as you scale your investments. If you found this video helpful and want more money-smart tips to help you live the dream, make sure to like, subscribe, and share this video with anyone who wants to create lasting wealth through real estate. Stay tuned for more insights on how to build your real estate portfolio and maximize your returns.